Hello and welcome once again to the Costing and Pricing Learning Program. My name's David Gilchrist and I'm presenting webinar number 3, which is starting off costing and pricing. In this webinar we build up on our previous discussions where we looked at introducing costing and pricing in webinar 2, and we will move on after this webinar into webinar 4 looking at costing practice itself. So in effect, webinar 3 is a webinar that looks at the continuation of the introduction of costing and pricing under a disability service organisation. Moving on then, the learning objectives of this webinar are fairly important for anyone who has not come across costing and pricing before or that might have worked in the sector for a long time and need a refresher on costing and pricing. Therefore, our webinar targets Chief Financial Officers, finance personnel, and also board members and others who might be interested in costing and pricing from a broader governance or strategic perspective. In that case, we'll build on our previous webinar to continue looking at costing, to look at costing in the context of individualised funding and person-centred care, also to highlight some essential rules that we think are really important tools to carry with you throughout your costing and pricing process, to discuss where information comes from and how you might look at that information in the context of decisions being made to undertake costing and pricing, and finally to look at costing a single service, just to get a view of how costing and pricing works in a very simplistic, from a very simplistic perspective. Let's get into it. Costing and pricing, of course, is a complex process, an important process, but a complex process. It's important in order to be successful in costing and pricing, and costing particularly, to be very confident in terms of your understanding about how costs behave. And in this webinar we will focus primarily on costs and how they behave. We'll look at some of the definitions of costs, definitions that often we're quite used to hearing or thinking about, but I guess sheeting them home to what we would call common definitions in the context of the costing and pricing learning program. As such, knowledge of the ways in which costs behave generally has been lacking in the sector to a certain degree, because we've not really had to undertake costing and pricing in a formal sense in most jurisdictions around Australia. Therefore, we're hopeful that this will be a part of the opportunity to reset the way people look at costing and pricing in the context of disability service provision, and in this webinar particularly we'll look at that very closely. In terms of starting off costing and pricing though, as we mentioned in the previous webinar, we're really looking at activity-based costing, or ABC costing. As I mentioned in that seminar, and for recap purposes, in the NFP area, this means that each service we provide, whether it's a support service or another type of service, or even a good provided to somebody for a specified purpose, is something that we would cost as an activity. Whether it needs to be costed at that level or at a higher level is something that we need to decide upon. So, for instance, some goods have components and some services have components of activities, and you might need to cost at that higher level or lower level. It's important to recognise that in addition to this, not all organisations cost and price in the same way or are structured in the same way, and therefore it's very difficult for us to be extremely specific about costing and pricing throughout the costing and pricing learning program. We have structured, as many people would be aware now, the macro case study, which is designed to help people through an understanding of how costing and pricing works for an organisation. However, one of the overriding rules in undertaking the costing and pricing learning program is that people should consider how the things that we are saying affect your organisation and how they might need to be changed in order to ensure your organisation is able to implement costing and pricing to best effect for your ongoing financial sustainability. Let's have a look though in the first instance, in terms of starting off in costing and pricing, at some decisions and ideas that need to be considered before you actually step into the costing and pricing process itself. It's necessary to make a number of decisions. It's also necessary to identify a number of elements that are going to be the basis or form the basis of costing and pricing going forward. For instance, you need to know what units of measure you are going to cost. A unit of measure is a particular activity or a particular item that you might sell to a user, a service user, and it is the basis on which costs are applied and prices are established. It's actually the element that you sell, if you like, in your organisation. This is, of course, an important decision to make in terms of identifying what a unit of measure is, because it is that basis which then helps us to decide what your product is, but more importantly then, what kinds of costs are allocated to that product. It also makes a difference in terms of what kinds of costs might be considered to be direct costs or indirect costs, because the higher up the organisation chart, if you like, you undertake your costing process, then the more change there is in terms of what is a direct and indirect cost. For instance though, a unit of measure might be costing a bed week. It might be a bed day or a bed hour. It might be an hour of personal service, or it might be the sale of a particular item that helps somebody within to cope with their service requirements and support needs. The decision can have significant impacts. Where we decide a product is something at a more granular level, that is at a lower level than a higher level, the complexity of costing can be far greater, and therefore the costs associated with costing can also be greater. There is therefore a judgment call to be made as to how to identify a unit of measurement. What you might be best off doing, notwithstanding this costing and pricing learning program is not developed purely for NDIS purposes, but you might be best off mapping your services to those purchased under the NDIS regime, so that you can see and cost according to those particular items. And there's a certain element of logic in that, because of course it is those items that are going to be purchased by people who receive support, financial support, via the NDIS structure. The second thing that needs to be determined, of course, and which will be determined largely based on what you identify as a unit of measure, includes what costs are fixed, variable, direct, or which are overheads. We talked about the nature of fixed, variable, direct and overhead costs in the last webinar, in webinar number 2, where we introduced some definitions relating to those elements. And we'll talk about those definitions and how to recognise those costs more deeply in the next webinar, where we actually get into costing practice. However, for our purposes today, fixed costs, variable costs, direct costs and overheads are all elements of costs that are ascribed to or allocated to units of measurement in particular ways because of the nature of those costs. The third element that we need to be aware of after having made those two decisions is to actually estimate our activity levels for each unit of measurement that we're going to be providing within the period of costing. Activity-based costing is about forecasting three essential things. Firstly, what your costs are likely to be. Secondly, what level of activity you're likely to have for each unit of measurement. And then thirdly, the timing of those two aspects. In estimating the activity levels, we're looking at a process where we're trying to determine how many units of each type of measurement you are going to be selling, if you like, into the market, and therefore how many units you have an opportunity of selling to recover your costs of service. The final point, of course, that you need to decide upon is to identify the financial outcomes indicative of future expense levels. In other words, one of the things that you need to do is look at the history of your organisation from an accounting or financial perspective, and use that history to try and identify and to predict what activity levels you're likely to have, and also what the costs of those activities are likely to be. There are also, though, some essential rules that are really important to be carried forward in your tool bag as you go through costing and pricing in your organisation. And these are pretty straightforward, but they can be forgotten by people because of the nature of costing and pricing, and particularly because it tends to be quite complex and it does take a lot of time. But remember, it's always important to be consistent in your calculations. Comparing one iteration of costing and pricing to the next is only possible if you're actually consistent in your definitions and in your expectations. Secondly, always start with history and move forward. In accounting terms, there's no better predictor of costs or activity than what you've already done. And if you're going to change your expectations dramatically, or you expect some significant changes as compared to your history in terms of costs or activity levels, then you really need to substantiate that and make sure that you feel comfortable that your new forecasts are actually realisable. Otherwise, you're really just fooling yourself. The third element is, of course, that you need to establish true costs within the bounds of usefulness and benefit. In our last webinar, we talked about the cost-benefit ratio, or the cost-benefit rule, and this rule applies equally in this webinar. In other words, we want to undertake a costing process, a costing and pricing process that is sufficiently robust to allow us to feel comfortable in terms of our expectations, and also to allow us to strategize for financial sustainability, but equally is not so painfully developed that it costs us quite a lot in time and money, but doesn't really relate to or provide us with a significant benefit over and above what we might have done had we done slightly lesser work. Remember, costing and pricing costs time and money. You need to be as sparing with that activity as you do with all of your activities in order to shepherd your resources. You also need to identify your assumptions, and more importantly perhaps letting board members know what those assumptions are. The assumptions relate to what are fixed and variable costs, what are direct and indirect costs, and also what are your expected activity levels and how you rationalise and substantiate those expectations. Always check for reasonableness and errors or omissions. It's an iterative process, and you're not going to get it right the first time, and in fact you're going to continue to, if you like, refine and make it more and more reasonable, more and more correct as you go through each iteration. Therefore, you always want to check reasonableness, and you always want to check errors or omissions, or check for them, as well as have other people perhaps overlooking your calculations and your expectations to make sure it makes sense to third parties. You can always get a second opinion, and always focus on the material costs and programs. So like the cost-benefit rule that we talked about a little while ago, it's important to really look at costing only those material costs and programs and not get stuck in the quagmire of costing and pricing to the minutiae that doesn't really help you in terms of strategic capacity going forward. You need to get outside advice if you feel uncomfortable. It's a completely normal and appropriate process for boards and for executives to take as they enter this process. And you also need to remember that it's critically important that you're costing for future, and that you're costing for the level of expected activity of your organisation, not its capacity. Some people fall into the trap when they look at costing and pricing, for the first time particularly, of looking at the level of activity that is possible to be undertaken by an organisation, rather than that level of activity that is likely to be undertaken. And of course, you need to recover all of your costs as a result of the expected level of activity that you're likely to undertake, as opposed to what you might be able to undertake as an organisation if you, say, had an extremely good year, or if no staff were sick and so on. It's really important to have that sense of relativity. When you're looking at costing and pricing, of course, the other element that's extremely important is where you might go to for sources of data. So what kind of data do you need? How do you identify what costs there are, and how do you pull those together in a tool to actually develop the expected costs of your units of measurement, and then to be able to work towards establishing a target price for your units of measurement. In order to undertake the costing process, you need to source data, as that data is what you use to estimate the outcomes. When you source data, as I mentioned before, a key rule is to start with historical experience. Go back and look at what your financial system's telling you your costs have been traditionally, and go back and look at your traditional activity levels, and use that as the starting point for your estimates for the following year or following few years. Historical data can also be used to indicate the types of activities, or what we call the activity mix. In other words, what types of units of measurement you might be providing and what the relativity or the numbers of those units of measurement are in your total activities. And that's of course very important as well when you come to allocate costs to each unit of activity. The other important area to look at, and this is particularly important under the NDIS because we don't really know what the NDIS is ultimately going to look at. We do probably know 75% of the style of the funding arrangement, but we don't know the full funding arrangement, and therefore we need to continue to keep an ear to the ground in order to source contextual information from the sector to be able to gather intelligence and to be able to drive our costing and pricing processes forward, taking into account new changes and expectations from funders. And this is really important because, of course, particularly under the NDIS regime, we know full well that historically we don't have that history, if you like, represented in our financial reports or in our activity statements. The third element to look at as well for sourcing data for costing and pricing relates to your organisational strategic planning documents. So your strategic plan and your business plan, of course, will look to identify where you need to go and what you're intending to do, what the board has agreed to as being your plans for the next 3 or 5 or even longer number of years. Of course, the strategic plan doesn't necessarily give you specific data on costs and prices for UOMs individually, but it will give you an idea as to what your planned activity levels are, and it will also give you an idea of what amounts of capital are required to expand your organisation or change your organisation, as well as to give you an idea about kinds of asset replacements that are going to be necessary. All of these things are critical parts of determining what the cost of a UOM is going to be, and also ultimately what your target price is going to need to be as well. Now, getting on to target price, remembering from the last webinar, a great deal of work and time in this costing and pricing learning program is focused on these 3 elements in order to identify the target price gap. That is the target price, the price that we would like to be able to achieve in order to ensure our financial sustainability, and that price is actually the result of the costing and pricing process as compared to or taken away from the achieved price, which is the price that's actually provided by the funder themselves. So for instance, it might be the price offered by the NDIA for services rendered, which will give us the target price gap. The target price gap is critically important for us to understand in order to support our sustainability going forward. It's the target price gap that we are looking to calculate all of the time because we know full well that the achieved price is always going to be different to the actual target price that we're looking to have. By and large, unfortunately, because of the history of funding in Australia for human services, it's quite likely that that target price gap is going to be negative. In other words, our target price is not going to, is less likely to be equal to or greater than the achieved price, the actual price received by a funder. And this is really important for sustainability purposes because, of course, that helps us to understand the extent to which we're actually recovering the costs of service delivery in an immediate sense, but also the extent to which we're able to develop surpluses which can then be used to replace assets or to develop up other opportunities for our organisations in terms of fulfilling our strategic planning, etc. So if a target price and achieved price results in a target price gap, we need to know what the impact might be if it's negative or positive. If the target price gap is positive, in which case your organisation is making what we call a super profit on a particular product, or it's negative, this is going to have connotations for how you approach sustainability going forward. It's also important to remember that the target price gap is calculated on a per unit of measurement basis. So that is on each type of activity that you provide, and therefore it's not going to necessarily be the target price gap for each individual activity that's going to be important, but rather the calculation of all of the activities you undertake, and particularly the mix of activities, because you might find that you have a negative target price gap for some activities that are relatively small and immaterial, and which is covered by, or rather supported by, other activities that return a much better result for you. Just remember though that if the target price gap is negative, you need to examine the impact of this on your organisation and to determine the best way to remedy it. If the gap is caused because you're not paid enough to cover your margin, this will have short and medium term impacts on sustainability. If the gap is caused because your organisation is not paid enough to cover your margin and depreciation, this will likely have detrimental effects on medium-term sustainability because you can't then turn around and reinvest in assets or replace assets to continue to operate. If your target price gap is positive for a particular activity or all of your activities, this is a very good thing for your organisation, and you should plan and strategize accordingly to take advantage of that particular outcome. Let's move now to some of the key cost elements within costing practice itself. Firstly, I would like to say before we get into some of these definitions and to talk about some of these cost elements, it is important for people to recognise that the National Costing and Pricing Framework is also available on the Costing and Pricing Learning Program website, and all of the costing practice definitions are listed there in a glossary, and it is that glossary that we use throughout the Costing and Pricing Learning Program to make sure that we're consistent in how we identify definitions and also to allow you the opportunity to be able to learn those definitions and understand them through the use of that consistency. In terms of costs though, of course, as we foreshadowed in the very start of this webinar, there are a number of types of costs, and we generally divide those up into fixed and variable costs and direct and indirect costs. In this particular slide, we're interested in fixed costs, and fixed costs we tend to look at as being incurred whether or not you actually undertake activities. Typical examples of fixed costs include things like head office costs, the CEO, and other costs of that kind of nature, so costs that will be incurred even if you don't sell one unit of measurement. They tend not to vary in the short term. However, you need to remember that, of course, all costs change in the long term. Fixed costs and variable costs will change in the long term. Importantly as well, we will talk about the idea of relevant range in the next webinar much more deeply. However, it's important at this point to understand that the relevant range is also a consideration here for determining what is a fixed and what is a variable cost. The relevant range is that level of activity over a particular time frame for which your assumptions are correct. That is, you're making assumptions about what's a fixed cost, about what's a variable cost, what is a direct cost, and what is an indirect cost. The relevant range is that period of time and that level of activity where those assumptions are correct. So for instance, if you have one nursing home of 40 beds, then your relevant range is of course that 40 bed and the level of average occupancy that you might have over that particular facility. If you add a second nursing home, then like as not you go to a whole different relevant range where discussions about what's fixed and what's variable might change, but also the components of fixed and variable costs might change as well. For instance, going from one nursing home to two might mean that you have a head office and a CEO, whereas before you might have had a supervisor and an office on location in that original nursing home. So again, we will talk much more deeply about relevant range in the next webinar, but it is important to remember that all of these ideas about fixed costs, variable costs, and costing and pricing practice itself is a changing feast. It moves all the time, and you need to be on top of some of the assumptions that you make to make sure they're continually relevant to the decisions that you need to make as a result of the costing practice you undertake. The next element, of course, is variable costs. And variable costs are those costs that are incremental to services provided. In other words, we have an expectation for each additional unit of measurement that we provide, there will be one additional unit of variable costs incurred by the organisation. In other words, we have an expectation that variable costs are always uniform, and we also have this funny expectation that those variable costs are not incurred if you do nothing. In fact, these both variable costs and fixed costs are ideas that are created to help us to undertake a costing and pricing process, but they're not necessarily true in the fullest sense. So in other words, while we might consider that direct labour costs are also variable, so where we have carers going to provide services, by and large, if you have a full-time permanent carer on your books, then their costs are going to be incurred whether you undertake any services or not. And so it's very important to understand how costs work and to understand the function of costs in undertaking this costing and pricing process, because we make some assumptions that are really important to understand in that context. However, variable costs typically are costed or ideas of costs that relate to the level of activity and are expected to rise or fall depending on the level of activity that we actually undertake. The third element that's important to think about is the idea of direct costs. And I mentioned before that often carers' salaries are considered to be variable costs because we tend to allocate them on a, if you like, a per job basis or a per unit of measurement basis. They can also be considered to be direct costs. They are those costs that are directly or clearly attributable to an individual activity. So a unit of measurement in being undertaken, being prepared for, or even being finalised, so the writing up of notes or anything of that nature, all contribute to the delivery of a particular service and therefore are considered to be direct costs of an organisation. They are for an actual service activity, and they can be both overheads as well as variable costs. In other words, a direct cost can be a fixed cost if it is, for instance, relating to a supervisor who might be directly supervising care services, or might relate to a regional office that's set up to be able to house clients or to interview clients or what have you. The important point here is that CFOs, CEOs and others need to make decisions about how to define direct costs, indirect costs, fixed costs and variable costs for your particular organisations based on the types of activity you undertake and also based on the cost of costing and pricing for your organisation. Remember, the more granular, the more specific and accurate you try to be, the more cost incurred in undertaking that particular accounting activity. I guess the final point here is to note that direct costs might be clearly attributable to an individual activity. Indirect costs are generally considered to be opposite of direct costs. In other words, they're costs that are not easily attributable to an individual activity, and they might also include things like overheads such as CEO salaries and head office costs and so on, all costs that are both fixed and indirect. So it's fair to say that usually fixed costs are indirect costs and usually variable costs are direct costs, but it's not necessarily the way that we would define it. Okay, the final, the next point in costing practice that needs to be thought through is how we actually undertake our cost estimation, and we've talked about the cost benefit. Remember, particularly, don't overdo it. Apply the 80-20 rule. That is, getting the last 20% right will cost you about 80% of your time generally, and therefore you need to really focus on what we would call the material elements of costing, those UOMs that are most important, that constitute the material part of your organisation and from which you expect to recover the bulk of your cost of service delivery. Remember too, it's an iterative process. You'll never finish costing and pricing. You go around in circles, costing and pricing and refining all the time, and re-undertaking, re-costing and repricing depending on changes in the way funding is undertaken, changes in the way you might recognise units of measurement, and in changes in activity and other levels that you might not have thought about when you first launched your costing and pricing program. So therefore you need to recognise that this is an iterative process and you need to be continually checking your figures in relation to what your expectations were compared to the actual outcome. As mentioned before, remember to be guided by historical costs, and also remember to schedule in likely cost increases and decreases to make sure they're taken into account. So for instance, most awards that disability service organisations operate under include opportunities for automatic increments for staff, and where those automatic increments are going to be taken into account in the following year, obviously your history is not going to inform you of that, but your estimates need to. Finally, on this particular section, just want to look at costing practice in a diagrammatic form. This diagram was introduced in the previous webinar, but just reinforcing the relationships between fixed and variable cost, our expectations in relation to changes in activity, and also some examples of those costs to help you to decide what is important from your organisation's perspective in terms of fixed and variable costs. Let's have a look now just to, I guess, finalise the discussion in this webinar and to consider a fairly simple example. We'll look at a single service costing arrangement. This is an organisation that only provides one unit of measurement. Now, obviously, this is quite unlikely for most people listening to this webinar because most organisations have more than one unit of measurement. In other words, most disability organisations provide more than one type of service. However, I think for illustrative purposes, it's useful just to look at a single service costing example so that we can then move on to costing practice in the next webinar. Everything you consume is consumed in the course of either maintaining the capability to deliver a service or in the direct delivery of services, and this is a really important consideration to take up. When we talk about expenses, we're actually talking about all of the things that are consumed in order to deliver a service or to maintain the capability or capacity to deliver a service. This is important because it's fairly obvious that staff costs, petrol costs or other costs associated with specific types of activities are of course needing to be included as part of the cost of activities. But there's also depreciation and other what we call accounting estimates to be included in those total costs as well, and they're part of the consumption but not necessarily part of the cash outflow. So one of the key things that needs to be identified on this slide is the fact that when we talk about the total annual costs of a particular unit, we're talking about the full consumption as opposed to the amount of cash that's gone out of the organisation as a result of providing this service. Therefore, to calculate the cost of a single service unit of measurement, our unit cost equals the total annual cost divided by the total annual volume of that particular unit of measurement. In other words, really, it's our total expected costs for the coming year divided by our total expected activity levels for that same year. And clearly, as we come to understand our annual costs and our annual volume more generally as we get into the new year, we're able to refine and make this calculation a little bit more accurate as we go. How does the costing become more complex than this? I think it's really important to understand that there are ascription and allocation issues that we'll talk about in the next webinar. Cost ascription relates to the organisation providing more than one type of disability service, and it actually allows us to ascribe or to apportion costs directly according to our expectation or the relationship of those costs to the activities we undertake. Ascription, therefore, is a little bit more accurate because it relates to our identification of costs that are what we call direct costs. On the other hand, cost allocation is a little less accurate, a little more subjective because it relates to the allocation of our overheads and our fixed costs, and therefore we have to come up with some subjective rules about how we allocate those costs to particular activity levels. And of course, we've always got cost estimation issues as the value of the organisation grows as you pursue your strategic plan, and also as the general economy changes. We have an expectation that our costs will go up, that our organisation will likely expand as a result of what we do, and also that we need to pursue our strategic plan, which might also include growth or changes in the mix of our particular activities. Overall, though, when we look at single service costing or indeed multiple service costing, there are a couple of fundamental rules about how costs are ascribed or allocated. When we ascribe costs, we typically ascribe direct costs, so direct labour, direct materials, and we can ascribe those because we incur those costs in actually providing a particular service, and therefore we would argue that when we talk about direct costs, we're fairly objective in our measurement of those costs. On the other hand, when we talk about indirect costs, so indirect labour, indirect materials, things like head office and CEO costs, we tend to think of it being much more allocative. In other words, we're being much more subjective about what we're doing, and therefore we're making assumptions about the connections between activities and those particular costs. For instance, we might allocate overhead costs simply based on the turnover of each division in the organisation, or we might allocate overheads based on the relative complexity of a particular UOM as compared to another activity we might undertake. Therefore, there's two things about allocation that are really important to remember. The first is it is subjective, and therefore it's subject to change and subject to equity, if you like, making sure that it's allocated in a way that is supportable and sustainable for your organisation. But the second is it needs to be allocated in a fair way so that all of your costs are allocated across all of your activities. And this might also have a strategic impact on your decision making in your organisation. For instance, you might currently have a fundraising division in your organisation that raises relatively little funds, but it might have political or other elements of utility that are really important. If you have a fundraising division, though, you need to allocate and ascribe cost to that division, which will reduce the cost allocated to other divisions, and therefore there's a strategic question mark over the number of divisions you might hold and how you might deal with those divisions as you strategize around costing and pricing for your organisation. Of course, all of the costs ascribed and all of the cost allocated form the cost of your unique product or service for each iteration of those products or services, or each unit of measurement. That really concludes this webinar. In the next webinar, we'll get into costing practice more deeply. We'll build on webinars 2 and 3, where we introduced ideas around costing and pricing, and we'll work on costing and practice and look at costing and practice in the context of a much more complex disability service organisation. In the meantime, we're very happy to take any comments or questions from any participants in relation to this content, so please contact us accordingly. Otherwise, we look forward to seeing you at the next webinar, which is webinar 4. Thank you very much. Look forward to talking soon.